Welcome to the Dollars and Cents podcast. Today we're coming to you from the City Personal Finance Festival and we're tackling a question that every investor has thought about at some point in time. Should the average investor try to beat the average market return? And joining me today in this episode is Xin Yang from uSmart. Xin Yang, welcome to the Dollars and Cents show.
Thank you for the invitation.
My first question to you is that when people always talk about the average market return that you can get, what are they actually referring to?
Typically, the average market return refers to the 8 to 10% returns generated by the S&P 500 index on a yearly basis. So obviously, it's not like a one number universal rule whereby it's just S&P 500 index. There are many indices out there. For example, in Singapore context, is the Straits Times Index, STI. Then in Hong Kong, we have the Hang Seng Index. Then obviously, there's many indices all over the world. Most importantly for the investor is which geographical region of interest are you going to invest in. Then you look at the indices to see, okay, how are they performing. Then before zooming into the specific segment or stocks that you're interested to invest in. Yeah.
And I just want to ask also, like today, information is so readily accessible, right? You just go onto YouTube or TikTok, and depending on what you have been surfing, you might see more finance YouTube videos or TikTok videos telling you what you should invest in or how you should invest. Do you think that because information is so readily accessible these days, it makes people feel very confident that, hey, they have some special knowledge that I can beat the market?
For me, I think it really depends on which stage of investment are you in. Okay, so let's put in the context of a beginner investor. Okay, when they get exposed themselves to social media or even YouTube videos, their objective, in my opinion, is not to actually beat the market. Because look at yourself as a beginner, you don't even know what is beating the market. Okay, you just want to get started, how to open an account, how to press the buy or sell button. That's it. Okay. However, if you're talking about a seasoned investors, okay, in terms of the information out there, okay, investors like us who have been in the markets for quite some time, we don't really rely on a lot of information available on YouTube or social media as a form of key pointers to make investment decisions. Okay, because investors, we want to live in the future, 6 months or 1 year down the road. We want to know what may happen. Okay, most of the information when they're being broadcast is really what had happened. Okay, so for us, we wanted to always, obviously we want to be competitive in markets, but seasoned investors, we don't really rely a lot of such information to we become like, okay, this is the stock pick I want to follow to beat the market in this case. So it really depends on your investment stage. Where are you? Okay, over here.
What are some investments that I really should consider?
At the start, always try to focus on diversification. Okay, go into the core, just a simple core ETF. Okay, there's so many ETF out there. Okay, use it at the start in terms of getting the average market returns first. Okay, in terms of other aspects like trying to beat the market. Okay, use a smaller portion of portfolio, maybe 10%, 20%. Then you dabble into those things that may give potentially higher return or more exciting opportunities like derivatives. Then you deal with that. But the core start will always be the diversification on index fund, at least for every beginner investor out there.
Do you think that investors in general feel the need to beat the market? Is there a FOMO where, hey, everybody is talking and just saying last few years Nvidia and Tesla, and I'm seeing it in the news, and if I don't invest in these stocks, I see people getting 2x return, 2 times the share price grow while I'm only making 10, 15%. Do you think there's a part where people just FOMO?
Right, it's always human nature to be competitive, right? We want, as you mentioned, we want to find out which company can be the next Nvidia or the next Tesla, okay? And in terms of the social media, obviously, when someone sees something very exciting on YouTube, they say, I just want to follow, okay? But objectively, you need to ask yourself, okay, from a fundamental point of view, when you do any form of investment, does it fit your lifestyle need? So for example, if you are targeting just 8 to 10% return every year, okay, just dabble into index ETF. You don't really need to follow what people are telling you to do. I think that's the most important thing, rather than just following blindly what other people are telling you.
Talking about prices spiking, the talk, at least in the last few weeks, has been gold prices, right? And gold prices has recently hit a high, and I see a lot of people, both experienced as well as new investors, now talking about whether they should invest in gold because gold has performed so well in the recent years. What should the average investor think about it?
We always understand from past performance do not guarantee future results. Okay, so if you are buying gold because of the reason that gold has been going up a lot in the past 1 or 2 years, then that's not a reason. Okay, that's just following the herd. Okay, if you are telling me that the past 2 years gold has been going up a lot, and you feel that in the next 1 or 2 years you will continue to go up because of ABC reason. Okay, there's analysis being done to it, then that's fair enough, because obviously we don't know where the markets are going. If there's a reasonable justification for gold to go up, okay, then just go into it, but not just because past 1 year, 2 year go up ready, then you go into it, then there's no reason for doing that.
I think even if you think that gold prices are going up, sometimes it's also about portfolio allocation as well, right? It's not about putting every single dollar you have into gold, hoping it'll go up, but also about diversifying away from, traditional equities and bonds and perhaps into gold, which kind of like acts sometimes as a hedge against, the financial markets, especially when things might be a bit volatile. What do you think, they should think about, moving forward in terms of their investment strategy?
So if you are underperforming a market for quite some time, it can be a couple of things. It can be that the market conditions that you have been investing in are not suitable for your current strategies, or you're just not well equipped enough with the skills. So you still can continue to invest. Obviously, you need to stay invested. As we know, compounding always is the most important thing. Okay, and going back to what we mentioned earlier, whereby stay invested, but you still allocate a small amount of money to test, to continue trading markets. So make sure that as you equip yourself with more skills, okay, you can test yourself whether you can outperform your market in the future. Okay, but you still have to stay invested in your core portfolio. Then you just dedicate a small amount of money to see, okay, am I getting better? Okay, then you test it using a smaller amount of money. Okay, that's the same old logic for every investment.
We live in a very global world today, and I think I remember when I first started investing, it's typically on the Singapore market, the SGX. But today, I think increasingly people are looking at overseas market as opportunity to capture maybe so-called greater growth, whether it's in the US, China, or other markets in Asia. Do you think it's important for Singapore-based investors to not only think about investing in the Singapore market, but also certain overseas?
It's very important because in terms of investing, you need to look at how many opportunities are there out there. Okay, because if you are just looking at Singapore market, it's just very, very small. It's a Straits Times Index, there's only 30 companies out there. Okay, and we look at S&P 500, there are 500 companies for you to choose from in terms of the business model of the company you're doing, in terms of geographic regions. So in terms of investing, we always want to have more opportunities for you to find, rather than just stick to Singapore because you only know the very familiar names that you have in Singapore. Okay, so that's where the learning comes in, because some investors they just want to invest in Singapore market, only knowing that all these counters familiar to me, DBS, OCBC, UOB, Sheng Siong, very familiar, but they don't really expose themselves to more opportunities out there. Okay, so it's very important in the investment world that we live in. Yeah.
Maybe just one last question. For someone who start investing just say, for example, 12 months ago, and they want to track their performance right now and they feel like, hey, I'm not doing so well. Is it too short of a timeline for them to really, measure, how they have performed?
For the past 1 year, if anyone bought something in the US market, he or she should be in the green. Something is really, really wrong. Okay. Going back to your question, okay, let's assume that the past 1 year has been quite a bad market. Okay? Everything has been dropping. To test yourself, I think most importantly, apart from the result, is your psychological well-being, whereby when you put in a position and it moves against you, how do you behave? How do you react to it? Because let's say after 1 year, you still cannot sleep well at night because you traded something during the US market and it goes against you, you panic sell, then it means that you are still not there yet.
Yeah.
Okay, so I think the psychological aspect is very important rather than just looking at the performance itself.
Do you think in that case a dollar cost averaging approach would be a smart way to enter the market? So in that case, instead of investing too much money at one go and then perhaps the market moves against me, I just invest a smaller amount each month consistently so that even if the market moves against me, I'm able to get in at a lower price, so I average out my costs.
Yes, definitely, especially when we look at current market situations has been going up. So some investors may not want to keep on doing that because they say keep on going up, then I keep on buying at a higher price. I want to change my strategy in terms of I only wait for it to go down and I buy. but you can't really time the market. So make it very disciplined, very stringent. Every month, just allocate X amount of money to broad index ETF. Then you just have to ignore any other things else because you really can't time the market. Timing the market is much more important than really timing the market.
Yeah, I think that's so true, especially if you are a new investor and you consider yourself just an average investor. Sometimes it's better to have more time in the market than to time the market. And thank you, Xin Yang, for joining us for today's Dollars and Cents podcast episode.
Thank you, Timothy.
And for those of you who are watching this episode, if you have any thoughts and comments, feel free to leave us your thoughts. And we hope you enjoy this episode. Also, if you enjoy the episode today, don't forget to follow us on the Dollars and Cents podcast, either on YouTube or Spotify. We'll see you again.